Okay, as we discussed earlier this morning, I think clearly the most significant trend is the rise of passive. So assets are increasing, every month they make new record highs in inflows. So it's clearly a trend that is affecting all of us. As we discussed, passive means a lot of different things. So from very cheap index trackers up to all the way to semi-active or active ETFs. So in my opinion, ETFs or passive investment are just a tool. So they are here to help us as portfolio manager to be better able to allocate our portfolios. I think there will be always a space for active investors, and of course competition from passive is helping active investors to make better strategies and to focus more on alpha. So this trend has clearly focused the active strategies on being very active. So we see a lot of concentrated portfolios, strategies that have a very high active share. So this competition is making the active manager more active, and it's also giving us the chance to allocate to beta if we think it is important with a very cheap price. Another trend that we are seeing is, of course, the interest from investors, or in some cases the push from regulators to move a little bit into private assets. So we are seeing some funds or new structures like LTIF that offer some investments. They are semi-liquid, not entirely illiquid, but offer some exposure to private assets. And finally, I would say that with the decrease in interest rates, we are seeing an interest and a rise in offering of non-correlated strategies, arbitrage strategies. Of course, with low interest rates, now the competition from money market or government bonds is less, so there is room for long short, market neutral, merger arb, or whatever. So the situation, as we all know, is very complicated because there are a lot of uncertainties, not only geopolitical, but mostly because of the decision of the new US administration. So they, as we know, they are changing their minds quite frequently, and it's very difficult to make any plans, not only for investors, but even for companies. So since nobody has a crystal ball and we are all uncertainty, we are looking for more clarity. And in the meantime, from what I read and from what I hear from colleagues, most of us are broadly neutral in asset allocation. So we try to navigate this period of uncertainty by being neutral on the equities weight. We have been shifting, but within that weight, we are shifting some weight away from US into Europe. So we are overweighting Europe relative to US. And then we are changing strategies. We are introducing income strategies or value strategies compared to the more aggressive growth strategies. On the fixed income part, again, we are broadly neutral in terms of weight, but we are definitely in the shorter part of the curve. So we are looking forward to extend duration, but because probably long-term rates are going to fall, but because the economy will slow down, but there will be volatility. So we prefer to stay on the medium part of the curve, up to 5-year maximum, and we try to stay in governments or very high-quality investment-grade issuers. Because the spreads are tight, so there is not a large enough cushion to protect from volatility. On the other side, even if fixed income probably will fall, we have some pressure because US is going to have a huge deficit. They will have to finance it in some way. And at the same time in Europe, Germany is going to spend a lot on defense, and Europe is going to spend a lot too. So there will be some pressure on the long end. So again, uncertainty, and we are waiting for some clarity. As I just mentioned, I think that fixed income, long duration fixed income will gain interest from asset managers as soon as the situation is more clear. In that space, I think the flexible bond strategies where you delegate to the asset manager to navigate fixed income can be useful because they can have all the tools to invest from the safe government bonds down to the subordinated debt, and they can allocate according to the views. So you can outsource this process to them, and I think they have a place. And also, as I mentioned before, with low interest rates, all the arbitrage strategies and the non-traditional long-only strategies can play a significant role.